Welcome back to the DeFi Research Corner, our sixth deep dive. Today we're tackling something huge, the growing connection between traditional finance and the Ethereum ecosystem. Let's try to get a sense of scale first. Picture the entire global financial system, all the money, stocks, bonds, everything.
It's vast. Carles Cerqueda from the Cambridge Center for Alternative Finance and also working with the BIS, it's a figure on just the publicly trackable part, roughly $265 trillion.
265 trillion. It's hard to even visualize, right? Like this immense deep ocean.
Exactly. And if you then look for what's actually on chain right now, specifically in DeFi, well, the numbers we're seeing from our sources suggest it's somewhere around maybe 1% of that total.
1%. It feels almost insignificant in comparison,
Good.
like this vibrant but small coral reef sitting right at the edge of that massive ocean.
A good analogy. But here's the really interesting part and the focus of our discussion today.
That giant ocean, TradFi, isn't just ignoring the reef anymore.
Not at all. Some of its biggest players are actively exploring it, figuring out how to swim in it, maybe even integrate parts of it. And that's the transition we want to unpack. TradFi looking seriously at DeFi, especially Ethereum.
And for this deep dive, we've been looking at some really insightful discussions from people who are right there shaping this.
Absolutely. We're talking heavy hitters. Joe Lubin, co-founder of Ethereum, founder of Consensus. Robbie Mitchnik, who heads digital assets at BlackRock, a giant name. Carles Cerqueda, bringing that crucial regulatory and institutional perspective from CTAF and BIS, and Tomasz Stanczak, a co-director right at the heart of the Ethereum Foundation.
So not just commentators, these are the builders, the institutional leaders, the core protocol people. They're seeing it from different layers, from the base protocol up to the apps, and how it all connects with global finance and regulators.
And what's striking is, despite those different viewpoints, there's a strong consensus emerging from what they're saying.
Which is?
That Ethereum seems to be at a genuine inflection point right now for significant institutional adoption.
Okay, an inflection point. So our mission here is to really dig into that. Using the insights from these key figures, the research they point to, we want to understand why they believe this is happening now. What makes this moment different?
Right. And what does this institutional engagement actually look like today? What are the practical examples?
And critically, what needs to happen next? What are the roadblocks, the next steps needed to really bridge that 1% reef with the 99% ocean?
Exactly. Let's try and distill their insights and make sense of this evolving landscape for you.
So let's jump right into that first big question.
Yeah.
Why now? Like you said, we've heard about institutional interest for years. Robbie Mitchnik even mentioned BlackRock was looking at private chains way back in 2020. So what's actually changed? Why is this the inflection point?
That's the key question. The interest isn't brand new, but the underlying conditions seem to have matured significantly. Joe Lubin really laid this out well.
What was his take?
He argued that the foundational layers, the basic infrastructure needed, have finally been built out and are, well, mature enough to support this kind of large-scale institutional activity. He made an analogy to the early internet.
Okay.
It wasn't really until we got things like broadband that a whole new wave of applications and mass use became truly possible. He thinks we're hitting that kind of broadband moment for Ethereum and its whole ecosystem.
A broadband moment for Ethereum. I like that. So let's break that down. What specific parts of the infrastructure have matured? He talked about metropolitan Ethereum. What does that mean?
That's a really important concept he uses. Metropolitan Ethereum highlights that we're not just talking about the original Layer 1 mainnet anymore. The ecosystem now includes lots of Layer 2 networks built on top for scaling.
Like Polygon, Arbitrum, Optimism, those kinds of things.
Exactly. And potentially even Layer 3s for specific apps or privacy. The crucial development isn't just that these layers exist, but that they're becoming much more interconnected, more interoperable.
So it's less like a single congested road and more like an integrated transport system. Highways, local roads, express lanes, all linked up.
That's a great way to put it. And this allows for both horizontal scaling, handling lots of different users and apps across many L2s, and vertical scaling, running complex things efficiently on dedicated layers. It directly tackles those early criticisms about Ethereum being too slow and expensive.
Okay, so the infrastructure is bigger and better connected. How does that translate into real benefits that matter to, say, a big bank or asset manager?
Well, the consensus from these experts is pretty clear. Ethereum is now seen as scalable enough, affordable enough, and usability is getting, as Lubin put it, amazing. especially looking ahead with things like AI integration into user interfaces, which he predicted could happen in the next 12-24 months.
Let's focus on affordable enough.
Yeah.
How cheap are we talking, realistically? L1 fees can still get high sometimes, right?
They can during peak demand. But the overall cost across the ecosystem has dropped dramatically. Upgrades to L1 helped, like introducing cheaper blob space for data, but the real game changer for affordability in many use cases has been the layer 2s.
And how much cheaper are those L2s?
Paul Brody from EY gave some really compelling numbers. He mentioned transaction fees on major L2s like Polygon or Aptos can be just a few cents. He specifically contrasted this with traditional systems like Fedwire, the US interbank system, which he said can cost dollars per transfer. So using an L2 for moving value digitally can be significantly cheaper. And compared to peak Ethereum mainnet gas fees from a couple of years ago, it's night and day for many operations.
Cheaper than Fedwire for dollar transfers. That really puts the disruptive potential into perspective.
It absolutely does. And it's not just about the transfer cost itself. Paul Brody made this fascinating point about what low fees enable. He said, when transaction costs are negligible, especially on L2s, and if interest rates are, say, above 1%, it actually becomes cheaper to pay bills daily or even more often, rather than weekly or monthly.
Why is that?
Because the tiny cost of the payment is less than the value you lose by having capital tied up, or the interest you could earn on it. This opens the door to what he called streaming money.
Streaming money, like a continuous flow of payments.
Exactly. Instead of waiting for a monthly invoice cycle, value could flow constantly, matching the delivery of goods or services in real time. Think about payroll based on hours worked today, or supply chain payments triggered instantly upon delivery confirmation.
That would change cash flow management completely. Less need for working capital, better predictability.
Precisely. It aligns payments much more closely with the actual flow of value. It's a fundamental shift away from batch processing towards real-time settlement, all enabled by cheap transactions and programmable smart contracts.
Okay, so the tech is faster, cheaper, more capable. That's pillar one. What's the second major driver for this inflection point, especially thinking about those big regulated institutions?
That has to be regulatory clarity, especially the shift perceived in the United States. Joe Lubin spoke quite a bit about this.
How did he describe the change?
He contrasted the environment under the previous SEC leadership, which he felt was more adversarial. He mentioned subpoenas going out to researchers, attempts to reclassify Ether with what he sees as a significantly more constructive relationship now with the current administration and regulators.
Right, he used the term unstraitjacketed.
Yes, exactly. That feeling, that growing legal clarity, has a real impact. It makes it feel, in Lubin's words, much more safe and explicitly legal for big companies like BlackRock, or even for developers inside traditional finance or Web2 firms, to actually hold tokens, participate in DeFi, or build applications on public chains like Ethereum.
So it basically gets the green light, or at least removes the big red stop sign from the general counsel's office.
That's a huge part of it. Legal and compliance risk is paramount for these institutions. When that uncertainty starts to lift and the engagement with regulators feels more collaborative, it unlocks a lot of potential activity.
Makes sense.
And Lubin also added that this unstraitjacketed feeling empowers the champions of this tech within those large organizations. They can be more vocal, argue more effectively for resources, and push initiatives forward. They become better internal advocates.
Okay, so the tech is ready, the regulatory picture is improving. But are institutions moving just because they can now? Or is there a really strong financial pull? Are they seeing actual cost savings or new opportunities?
Oh, absolutely. The financial incentives are arguably the most powerful driver here. This isn't just exploration. They see massive potential for the bottom line cost savings, efficiency gains, even new revenue streams. Paul Brody from EY again gave some frankly astonishing figures.
Let's hear them. Where are the biggest potential savings?
Okay, first, cross-border payments. Think about EY paying suppliers overseas or receiving international client payments. Brody estimated that if they could move all of that onto stablecoin rails, the potential savings for EY alone could be around $100 million annually.
Wow, $100 million a year just from switching payment rails for one company. That highlights how inefficient the current system must be.
It really does show the friction in the traditional correspondent banking system. But he stressed the savings go way beyond just the transfer fees. He talked about the cost for a large company to simply process and pay a single invoice.
Okay, how much?
He estimated it costs around $100 per bill.
$100. to pay one supplier invoice. That sounds incredibly high. Where does that cost come from? It can't just be the bank transfer fee.
Exactly. That's the key insight. Most of that $100 isn't the wire cost. It's the internal process before the payment is even made. It's all the manual work. Finding the original purchase order, matching it to the invoice, verifying goods were received, checking terms and conditions, getting approvals, handling errors.
So it's the administrative overhead, the sheer labor involved in verification and reconciliation.
Precisely. And this is where smart contracts on a blockchain become potentially revolutionary. Brody suggested that automating that whole process, the matching, the verification, the conditional payment release using smart contracts could roughly halve those costs and be maybe 99% faster.
Because the smart contract can check everything automatically. Did the token representing the goods arrive? Does the invoice data match the PO? Are the conditions met? And then just release the payment token.
That's the idea. Instead of people shuffling papers or checking different systems, the contract enforces the business logic automatically.
And if you scale that saving across thousands, maybe millions of invoices for a large corporation.
The numbers get mind-boggling. Brody threw out an estimate for automating the entire procure-to-pay process globally using Ethereum and smart contracts, potentially saving billions of dollars per year. He mentioned a figure in the range of $3 to $4 billion annually just for that specific process.
Billions. Okay, now that's the kind of number that gets boardroom attention, even past the most cautious legal team. It really paints a picture of just how much friction exists in the old plumbing.
And Carles Cerqueda added more detail on these inherent inefficiencies that blockchain targets. He pointed to security settlement, T+2, meaning it takes 2 days after a trade for stocks to actually settle in the US, and it can be much longer, T+35 even, for other assets or regions.
Right, so your money or asset is locked up for days.
Exactly. Think about the sheer amount of capital just sitting idle during that settlement lag. Cerqueda mentioned a BIS report estimating that just in the US system, around $100 billion is locked up every month because of this delayed settlement.
$100 billion a month. That's pure deadweight loss.
Yeah.
Opportunity cost.
Totally. And then there's the complexity. The traditional system involves this long chain of intermediaries, custodians, clearinghouses, central securities depositories, each adding fees, time, and points of potential failure or credit risk.
Plus manual processes, potential errors, time zone headings for global trades.
It really does sound like a system designed for a different era, struggling in the digital age. And Joe Lubin brought in the perspective from inside the banks themselves.
What did he say?
He described banks as facing an existential crisis. Their compliance costs are ballooning, and they're often running on ancient core systems he literally mentioned, needing 80-year-old COBOL programmers to maintain critical infrastructure.
Wow. Technical debt on a massive scale.
Absolutely. So they are under intense pressure to modernize, to find more efficient systems. Blockchain and digital assets offer a potential path to leapfrog some of that legacy tech and build something fundamentally more efficient and transparent. They're actively scrambling for solutions.
Okay, so the picture is the tech's maturing rapidly, the regulatory fog is lifting, and the financial incentives, both cost savings and addressing legacy pain points, are becoming incredibly clear and compelling. Billions are potentially on the table. A key piece enabling all this seems to be tokenization. Let's dig into that. What exactly is tokenization in this context?
At its heart, like you said, it's taking an asset, could be money, could be a stock, a bond, real estate, even intellectual property, and creating a digital representation of ownership rights for that asset on a blockchain. That representation is the token.
So it's like a digital deed or certificate of ownership, but living on the blockchain?
Kind of, but it's more dynamic. The token itself is the representation of value or ownership, and it can be programmed with rules using smart contracts. Joe Lubin brought up Larry Fink, BlackRock's CEO, and his now famous statement about wanting to tokenize all the things.
Right.
Lubin sees this as a fundamental shift, similar to how standardization or digitization transformed other industries. It's about creating a common digital language for assets.
And how does that reduce friction and increase productivity, like Lubin suggested?
By putting different types of assets into a standardized, interoperable digital format, these tokens, you break down the silos they live in today. Traditionally, trading stocks involves different systems and processes than trading bonds or real estate or commodities. Tokenization creates the potential for all these different assets to be represented and exchanged on the same underlying blockchain rails.
So they can interact more easily? Trade against each other.
Exactly. That promises much greater liquidity, making assets easier to buy and sell and higher velocity, meaning they can move through the financial system faster and more efficiently. It smooths out the plumbing dramatically.
And it seems like the first, most obvious application of this is tokenized money itself, stablecoins, these on-chain dollars.
Absolutely. Paul Brody made it clear that stablecoins are acting as the main gateway drug right now. There's just this huge global demand for US dollars, for their stability and liquidity. Stablecoins meet that demand in a digital on-chain format.
And most are USD pegged.
He said something like 98% currently are USD denominated, reflecting that global demand. Though he did predict that might fall to maybe 70–80% over the next decade as stablecoins pegged to other major currencies, like the euro or yen, gain traction.
And this is enabling what Brody called on-chain banking, right?
Yeah.
He had that vision of future students getting on-chain accounts without even realizing it's different from a normal bank.
That's the potential seamless user experience. But this isn't just consumer stuff. It's a massive trend for enterprises and institutions, too. Robbie Mitchnik and Carles Cerqueda both highlighted BlackRock's BUIDL fund as a key example.
Yes, BUIDL, the one that crossed $1 billion in assets under management, or AUM, pretty quickly.
That's the one. BUIDL is really significant because it gives institutions a way to get exposure to US dollars and US dollar yield directly on-chain in a tokenized form. It's essentially a regulated money market fund investing in short-term U.S. treasuries, but the shares are issued as tokens on the Ethereum blockchain.
So institutions can hold tokenized T-bills on-chain and earn yield.
Pretty much. They get exposure to very low-risk government debt, earning yield, all within the blockchain ecosystem. And crucially, it's designed to work smoothly with stablecoins like USDC.
Allowing them to move between stable cash and yielding T-bill exposure easily on-chain.
Exactly, seamlessly. Robbie Mitchnik did provide context, though while $1 billion AUM is impressive for a new fund like this, BlackRock's total cash management business is enormous, like $800 billion. So BUIDL is still a drop in the ocean, but it shows the potential if this model catches on.
And Carles Cerqueda added that detail about settlement speed.
Yes, that the settlement for transferring these tokenized BUIDL shares happens in under 30 seconds. Compare that to the T+2 days it typically takes to settle traditional treasury bills. It's a dramatic improvement in efficiency.
So BlackRock, a TradFi behemoth, is putting traditional T-bills onto Ethereum, settling them near instantly, and even using DeFi components like Uniswap in the process. That feels like a major validation.
It really is a powerful signal, and it's not just about using external stablecoins. Carles Cerqueda pointed out that banks are also building their own internal tokenized money systems.
Like JP Morgan's JPM coin.
That's the best-known example. It allows their corporate clients to represent deposited funds as internal JPM coin tokens for instant transfers within the bank's network. ING apparently also sees external stablecoins as more of a temporary bridge until these bank-issued tokenized deposits become more widespread.
So banks want their own digital cash on blockchain, partly to reduce reliance on third-party issuers like Circle or Tether, and manage their own risk.
That seems to be a key motivation. It gives them more control. And Carles Cerqueda also mentioned potential legislation like the Genius Act proposal, which could explicitly allow for yield-bearing stablecoins. Banks are likely anticipating this, planning tokenized deposit solutions that could natively offer interest.
Fascinating. The whole concept of money is being rebuilt here. But Paul Brody argued the real prize isn't just tokenizing money, it's tokenizing the stuff and the agreements around it.
Right. That's where he sees the truly massive savings and efficiencies unlocking. He estimated that something like 99.999% of stablecoin transactions today are just payments for things that were ordered, shipped, and verified through traditional off-chain processes. The big leap is bringing the asset and the contract onto the chain, too.
Tokenizing the stuff, like components in a factory.
That's a perfect example he used. Imagine building a phone. Instead of just paying for the battery with stablecoins after it shows up, the battery itself could be represented by a unique token. Same for the screen, the processor. As these component tokens move along the supply chain,
the smart contracts manage the whole flow.
Exactly. The smart contract could hold the payment tokens and only release them to the supplier when the corresponding component token arrives at the manufacturer's digital address and is verified, maybe by an IoT sensor confirming delivery. That's how you automate away the $100 invoice processing cost. The smart contract becomes the automated verification and settlement engine.
He brought up the Microsoft Xbox example, didn't he?
Yeah.
Even though it was private.
Yes, Paul Brody used that to show it's feasible. Microsoft uses smart contracts on a private Ethereum blockchain to handle transactions for game purchases on the Xbox network. They kept it private because they didn't want business details public, but it proves the concept. Smart contracts can manage complex, high-volume exchanges and business logic reliably.
And Carles Cerqueda also mentioned tokenizing currently illiquid things.
Yes, things like carbon credits or intellectual property. Assets that are hard to trade today because they require complex contracts and due diligence. Tokenization could potentially allow for fractional ownership, standardized trading on digital platforms, and bring much-needed liquidity, unlocking value that's currently trapped.
Okay, the potential seems enormous, but are institutions really doing this beyond just pilots? Are there concrete examples of major players using these DeFi rails for real transactions now?
Yes, definitely moving beyond pilots, and Carles Cerqueda provided some really strong, specific examples that show this convergence in action.
Okay, let's hear them. What did he share?
One was a partnership involving Uniswap, a core DeFi decentralized exchange, and BlackRock's BUID fund. It allows the fund to use the USDC stablecoin for subscriptions and redemptions of its tokenized T-bill shares.
So BlackRock is interacting directly with Uniswap protocol infrastructure for part of its regulated fund operations, settling in seconds.
That's what he described, settling in under 30 seconds, leveraging DeFi components. It really highlights how the lines are blurring. Another really key example he gave was an atomic repo transaction between Citi and UBS.
Atomic repo. Remind us what that is and why it's significant.
Okay, so a traditional repo or repurchase agreement is basically a short-term loan collateralized by a security, like a bond. It's crucial for money markets. But traditionally, it involves separate legs for transferring the security and the cash, which takes time and introduces settlement risk.
Right, the risk that one side pays but doesn't receive.
Exactly. In the example Cerqueda described, Citi tokenized a U.S. Treasury asset on a blockchain. UBS was the counterparty. They used a smart contract on an EVM-compatible Layer 2 to handle both legs, transferring the tokenized treasury and the tokenized cash or stablecoin simultaneously or atomically.
Meaning the smart contract ensures both transfers happen at the exact same instant, or neither happens at all, eliminating that settlement risk.
Precisely. No risk of one party defaulting after the other has performed. And Cerqueda said this transaction between these two global banking giants settled in under 30 seconds. It completely bypassed the traditional multi-day, multi-intermediary repo process.
Wow. That directly tackles those core problems of delay, capital lockup, and counterparty risk in the old system. These aren't just theories anymore. They're being demonstrated by major players.
Absolutely. And think back to Paul Brody's EY PayPal example, too. PayPal paying EY via stablecoin straight from PayPal's SAP system into EY's institutional crypto account. Fully automated, system to system, costing no more than a regular bank transfer. It shows how deeply integrated this can become.
These examples, BlackRock Uniswap, Citi UPS Atomic Repo, EY PayPal, they really drive home that this isn't just talk. Institutions are actively building and transacting.
Yes. And Carles Cerqueda backed this up with a broader observation. He estimated that about 2 out of every 3 financial institutions are currently exploring or actively running pilots using DeFi or blockchain protocols. The experimentation phase seems to be rapidly shifting towards practical implementation for many.
Okay, the momentum feels real. But for this to go from these early examples and pilots to truly widespread institutional use, what are the major obstacles? What still needs to be built or figured out?
Well, Joe Lubin highlighted an interesting challenge that actually came from the success in scaling fragmentation.
How so?
To get that massive scalability and low cost, the ecosystem developed all these different Layer 2 networks. That solved one problem but created another. It broke some of the easy, seamless composability we had when everything was just on Layer 1. It's harder now for different applications on different L2s to interact smoothly within a single transaction.
So we built faster highways, but now we need better interchanges between them.
That's a perfect analogy. Lubin emphasized that a lot of current research and engineering effort is focused on fixing this fragmentation. That means better standards and tech for L2s to talk to each other. It also means, as he put it, beefing up Layer 1 to help coordinate activity across all the layers more effectively.
And he mentioned specific research areas like native rollups and base sequencing.
Right. At a high level, native rollups is about exploring ways to integrate scaling solutions like rollups more deeply into the core Layer 1 protocol itself, making them feel less like separate networks. Base sequencing is looking at whether the Layer 1 validators who order transactions on the main chain could also help order transactions across different L2s.
The idea being that if L1 helps order L2 transactions, it could make cross-L2 interactions easier and more reliable.
Potentially, yes. It's about trying to restore some of that lost synchronous composability and efficiency across the whole metropolitan Ethereum system. Deep technical work.
Okay, so core protocol improvements are underway to manage fragmentation. What about the needs specific to institutions? What are their biggest remaining blockers?
Privacy. That comes up again and again as absolutely paramount and a major current hurdle.
Because while transparency is great for some things, businesses need confidentiality, right?
Exactly. Paul Brody put it very clearly. Institutions need two main types of privacy. Privacy of the exchange, who's paying whom, how much, for what, and privacy of the agreement terms, the specific details of the contract or deal. Without that, competitors could see everything, what you pay suppliers, who your biggest customers are, your trading patterns. It's commercially sensitive. Carles Cerqueda echoed this, calling privacy a current challenge, holding back wider adoption.
So how far along is the tech to deliver that privacy? And what do regulators think?
Paul Brody was quite frank that the privacy tech is still not very mature. He also acknowledged that regulators are understandably wary of fully anonymous systems. He mentioned privacy pools as something that raises concerns, with relatively good reason, due to potential misuse.
But progress is being made. ZKPs seem to be the main hope.
Yes, zero-knowledge proofs are seen as the key enabling technology here by pretty much everyone. Cerqueda, Brody, Lubin. The ability to prove something is true, like I have sufficient funds or this transaction complies with Rule X, without revealing the underlying sensitive data.
And there are projects focused on this.
Definitely. Things like Aztec Network's Noir language aim to make building private applications with ZKPs easier, and EY's own work with Nightfall for private transfers and Starite for private business logic. Brody talked about their goal of creating permanent privacy environments for entire business networks on-chain.
Running a whole complex business process privately, but still leveraging the benefits of a shared ledger.
That's the vision. But Brody also highlighted the significant technical challenge. Doing complex business logic and transfers privately using ZKP rollups is computationally very expensive right now. He gave examples of their systems achieving maybe 1-2 transactions per second compared to thousands for Visa, MasterCard. He thinks they need a major cost reduction, like an order of magnitude, before privately tokenizing things like industrial parts or NFTs becomes truly economical at scale.
And both Tomasz Stanczak and Carles Cerqueda stress the need for standardization around privacy, especially how it interacts with Layer 1. Institutions need a predictable, common approach.
Absolutely. Standardization builds confidence. Beyond the tech challenges of privacy, Carles Cerqueda identified another major barrier, this one more conceptual: the lack of a clear, globally accepted DeFi taxonomy.
A taxonomy, like a way to classify all this new stuff.
Exactly. Banks and regulators live in a world of clearly defined categories, asset classes, entity types, regulated activities, all mapped to existing rules like ISO standards. When they look at DeFi, a lending protocol like Aave, an exchange like Uniswap, they struggle to fit it into their existing boxes.
So the compliance team looks at, say, participating in a liquidity pool and asks, what is this? Is it lending, market making? What are the capital requirements, the reporting obligations?
Precisely that uncertainty, it creates a huge barrier. Institutions need to understand how interacting with DeFi maps onto existing regulations or what new rules might apply to manage risk and ensure compliance. This is where Carles Cerqueda highlighted the crucial work being done by the Cambridge Center for Alternative Finance, the CCA.
What are they doing specifically?
They did a massive analysis covering something like 98% of Ethereum protocols to build what they call the AAA taxonomy. It classifies DeFi based on activities like lending, trading, actors, users, devs, LPs, governance, and assets, stablecoins, tokens. The key is they framed it using language and concepts that align with traditional financial regulation.
So, translating DeFi into regulator speak.
Essentially, yes. Cerqueda used the analogy of turning cows into clarity, making the unfamiliar understandable. They even built a free interactive dashboard, ccaf.io, using this taxonomy so regulators and others can explore DeFi, see value flows, understand governance, all within a familiar framework. It's vital work for enabling sensible regulation.
That sounds incredibly useful. What about the Ethereum Foundation itself? We heard from Tomasz Stanczak, a co-director there. He mentioned their historical strategy of subtraction. What's that about? And what's their focus now?
Yeah, Subtraction was their term for a deliberate strategy over the years. The EF would help start key ecosystem projects, core research, client teams, etc., and then spin them off to be independent. The goal was to build resilience and decentralization, making the ecosystem less reliant on the EF as a single point of failure or control.
Spreading the functions out to make the whole thing stronger.
Exactly. But Stanczak noted that for the next year or two, the focus is shifting slightly. Decentralization is still key, but they also need to balance that with effectively winning being more focused, rather than just funding more and more large spin-offs.
So how does he see the division of labor between the EF and the wider community going forward?
He sees the community taking the lead on things like local growth, building applications, onboarding users and developers, starting VCs, engaging policymakers, marketing, experimentation. The EF, he argued, should concentrate its resources on core coordination, fundamental research, and especially the high-quality engineering of the most critical, complex parts of the base protocol.
He really emphasized that engineering aspect.
Yeah, he did. Stanczak highlighted the sheer scale of the engineering challenges. The peer-to-peer layer, data availability scaling, the consensus layer. He stressed the need for excellent engineering, speeding up the roadmap where feasible, and having the courage to change fundamental parts of the protocol if needed, while always prioritizing security. He also suggested the EF needs to tap into the engineering talent across the whole ecosystem, L2s, DeFi teams, for advice and contributions to the core.
And is the EF changing how it supports ecosystem growth, particularly thinking about institutions?
Yes. Stanczak mentioned they're completely rebuilding their ecosystem development function. The idea is to move beyond just giving grants and become more of a network builder.
What does that mean in practice?
Actively reaching out to different groups, institutions, DeFi founders, VCs, incubators, providing mentoring, making introductions, organizing specialized events, basically acting as a catalyst and connector. The goal, he said, is for everyone building on Ethereum to succeed, not just EF grant recipients. And they plan to be more open about their goals and metrics here.
Okay, another specific institutional point that came up was staking for Ether ETFs. Robbie Mitchnik from BlackRock raised this.
Right. He pointed out that their spot ETH ETF, ETHA, had seen really strong inflows, around $4 billion in its first 6 months, which is actually a big success for a new ETF, even if maybe not the frenzy Bitcoin ETFs saw initially.
But there's a catch.
The catch is that the current ETF structure doesn't allow them to stake the underlying Ether to earn yield. If you hold ETH directly or use a staking service, you can earn that staking yield, but ETF investors currently miss out.
So it makes the ETF slightly less attractive than holding ETH directly from a yield perspective.
Exactly. Mitchnik acknowledged it's complex to solve, technically, operationally, regulatorily, but he felt that if they could enable staking within the ETF structure, it would be a major step change upward for demand and activity around these products.
And Joe Lubin saw this as an example of institutions acting as a forcing function.
Yes. Lubin's point was that when big players like BlackRock come in, their needs and questions like how to handle ETF staking, or needing more predictability in execution layer rewards, or wanting clear ways to mitigate slashing risk through validator diversification, push the whole ecosystem to mature and standardized solutions, which ultimately benefits everyone.
Makes sense. Now, amidst all this focus on institutional adoption and integrating with TradFi, Joe Lubin did sound a note of caution, specifically about stablecoins backed only by traditional assets.
Yes, this was a really important point about long-term resilience and decentralization. Lubin warned that if the entire on-chain economy becomes overwhelmingly reliant on stablecoins backed, say, one-for-one by dollars in a bank or T-bills held by a centralized entity,
that creates a potential vulnerability.
Exactly. He called it a potential lever of control for external forces, governments, regulators, the banks holding the reserves. If those external actors decide to freeze the assets, regulate the issuer heavily, or interfere somehow, it could pull the rug out from under the on-chain ecosystem that depends on those stablecoins.
So the system's decentralization would be limited by its most centralized component, the off-chain backing.
That's the risk he highlighted. For true resilience, he argued, the ecosystem needs to foster and use a diversity of stablecoins, including those backed by decentralized crypto assets like Ether or Bitcoin, or perhaps real-world assets where the token's control is genuinely decentralized via DAO, not just held by one company. It's a reminder to think carefully about where centralization risks might still exist.
So summing up that section, incredible progress, huge potential driven by tech and market needs, but also real hurdles. We need to fix L2 fragmentation, crack institutional-grade privacy, get regulatory clarity via things like taxonomies, and ensure core components like stablecoins remain robust and decentralized.
That captures it well. The experts see a pivotal moment, but they're definitely not glossing over the significant work still needed across the board: tech, regulation, ecosystem coordination to realize the full vision for finance on-chain.
Okay, zooming out a bit, Joe Lubin didn't just talk about finance. He framed Ethereum as something much bigger, a major foundational component of Web3, what he called the re-decentralized web.
Right. He positioned it in direct contrast to what he sees as Web 2, the current internet dominated by centralized platforms, the walled gardens of big tech.
Which he described as often toxic.
Yeah, arguing their business models rely on monetizing user identity and data, and their centralized nature makes them vulnerable to attacks, like DDoS attacks he mentioned. He sees that architecture as fundamentally unsustainable.
In Web3, built on things like Ethereum, is the alternative.
That's his vision. Open source, open protocols, decentralized networks. It's about shifting power back to users, letting them own and control their identity and data, enabling community-built applications without needing permission from a central gatekeeper, moving away from intermediaries towards more direct peer-to-peer interaction.
And that ties into his ideas about the future of identity.
Absolutely. He discussed concepts like persistent on-chain identity may be managed by a user-controlled smart contract, like their old Uport project aimed for, with decentralized recovery methods, and importantly, not just one identity, but potentially containers for different personas: your official one, your gamer tag, your professional profile.
And these on-chain identities could collect verifiable credentials or reputation.
Exactly. Attestations from employers, schools, peers, maybe even governments, all stored securely and verifiably on-chain. He even floated an idea for a coincidence detection tool, using signed location time data to help verify real-world interactions, bridging digital identity with physical reality.
So governments might still issue credentials, but they'd plug into this more fluid, user-controlled system.
That seems to be the implication.
Yeah.
And this shift in identity and value transfer, he believes, will change regulation too. He predicted regulation becoming much lighter weight and more technological.
Lighter weight, how?
Oh.
Less paper, more code.
Potentially. Maybe regulators writing software specifications or automated tests that systems built on blockchain need to pass. He argued the transparency of blockchain, that shared ledger, real-time data, gives regulators an unprecedented view.
A real-time view of financial activity. How does that change regulation?
Lubin argued it enables much better regulation and systemic control. Instead of waiting weeks or months for reports, regulators see flows almost instantly. This could allow them to spot imbalances or risky behaviors much earlier, maybe even intervene more precisely to prevent crises, rather than using blunt tools like interest rate hikes based on old data.
A shift from reactive to potentially proactive oversight. What does that mean for the banks we were talking about earlier?
Lubin called the current banking situation a gold rush. He thinks the smart ones realized they missed the boat on previous tech waves and are now scrambling to get involved with blockchain. But he also suggested the fundamental need for financial intermediation might decrease significantly.
Less need for middlemen if smart contracts can automate trust and transfer.
That's the idea. It could lead to fewer players, but the ones that remain might be much more efficient, built on this more trustworthy, transparent infrastructure. He even called traditional fintech a symptom of clunky legacy banking systems, layers built just to make the old tech usable. On-chain systems might make some of that fintech layer redundant.
He really took the decentralization idea far, talking about network states even.
Yeah, he sees network states as a potential successor to nation states. Decentralized communities, maybe bringing together humans and AI agents, using tokens to coordinate towards shared goals. He described Ethereum itself as a kind of network state and said consensus aims to be one within Ethereum, helping others build their own projects or cities on layers like Linea using on-chain agreements.
It connects the tech directly to new forms of social and economic organization.
It does. And he noted this leads to jurisdictional and regulatory arbitrage, with countries competing to attract this fluid talent and capital. State identity remains important, but maybe within a more globalized, interconnected system.
It all seemed to circle back to that powerful call to action from Carles Cerqueda for developers.
It's time to rewrite finance.
Exactly. It captures the scale of the opportunity.
Cerqueda genuinely seems to believe the next $1 trillion in economic value will be unlocked on these DeFi rails, built on infrastructure like Ethereum. He sees it as a unique, the confluence of factors. The infrastructure maturing into metropolitan Ethereum, scalable, affordable, the regulatory environment becoming clearer, more constructive, feeling unstraitjacketed, and those massive financial incentives, billions in potential cost savings from tokenization and automation addressing real legacy pain points.
We saw how tokenization is already changing money stablecoins, BUIDL, bank experiments, and the potential to tokenize stuff and automate agreements.
Yeah.
We looked at those real-world examples. BlackRock using Uniswap infrastructure, Citi and UBS doing atomic repos, EY and PayPal integrating stablecoin payments into SAP. Real transactions happening now.
And we didn't shy away from the challenges: the need to fix L2 fragmentation, the absolute necessity of developing standardized, institutional-grade privacy solutions, the critical gap in regulatory taxonomy that CCF is working on, the evolving role of the EF in engineering and network building. Plus, that crucial caution about ensuring stablecoins maintain decentralization.
It really feels like Ethereum is at this pivotal crossroads, moving from a fascinating niche towards becoming a foundational layer for the next generation of finance and maybe the internet itself.
The convergence is powerful. Tech readiness, regulatory shifts, economic drivers, they're all pointing in the same direction, towards much broader institutional engagement.
Okay, so as a final thought to leave you, our listeners, with something provocative that came up in these discussions. Carles Cerqueda asked that question. Is AI already better than humans at decision-making? Tomasz Stanczak's answer was basically, not quite yet, but soon.
Right. Now, connect that thought rapidly advancing AI with everything we've just discussed about decentralized tokenized systems on Ethereum. Imagine a future where AI agents aren't just advising, but actively participating on-chain.
AI agents managing DAOs, automating governance, executing complex financial strategies, maybe even building communities, all transacting autonomously on these decentralized rails.
What does that world look like? A world where significant parts of our economic, maybe even social and political systems are influenced or managed by autonomous AI operating on blockchains. It's a mind-bending concept, but it flows directly from the foundational shifts happening right now. Definitely something to ponder as these technologies continue to evolve and emerge.